Hi folks, Tom Barnett here with the Financial Light Insurance Retirement Systems. I want to chat with you about some myths and some things that you're going to hear about indexed annuities or annuities in general. You're going to be told a lot of things from a lot of brokers about annuities, but remember there's a few key things you always want to keep in mind. The first is the reason that most brokers will tell you that they're not a good instrument is really simple. They don't offer them. And so if they don't offer them, they can't make any money off of that. So that's the number one reason that they're not going to offer them to you. The annuities that they do offer will be called variable annuities. Remember that term, variable annuity. All you have to do is remember the first part. How is your interest? How is your earnings? How are they going to come out? Well, that's going to vary. That's why they call it that. It is a variable annuity. You can still lose money in that particular instrument. A variable annuity has two key features. One, it makes a lot of money for the company that offers it, and two, they make a huge commission for the agents and the securities people who sell it. And those are the two key features. It does not help you. They're the worst instruments out there. But what about indexed annuities? You're going to hear, like I said, some rumors about that or some real myths. Key things that you're going to hear. One is they have a real poor interest rate or rate of return. Two is they have these long contracts, and gee, you can't do anything with them. Three, money inside of them. Once you put it in there, it's locked. You can't get to it. It's not liquid. They're just horrible that way. And you're going to hear things perpetuated just around those particular things. And the fees that are built inside of those annuities, they're going to tell you that they're absolutely high, that they're huge fees. And last but not least, those guys that sell them, man, they make these huge commissions off those particular instruments. Well, let's look at the common nomenclature of an indexed annuity. First and foremost, what many of these particular products do is they offer a bonus. How does that work? I'm going to use some round numbers because it's easier to do the math, plus it helps me look smarter than what I am, and that is really key. But more importantly, it's going to illustrate exactly how these particular instruments work. So we're going to say that we have $100,000. Now you don't need that much to put into these instruments. You can start with as little as $50 a month. A lot of them, if you want to get into the structures that we're going to talk about on these bonuses, require $5,000 to $10,000 to start. But you can start with as little as $50 a month. But on the basics, those who have about $5,000 or more to put in, here's how the majority of these annuities work. Number one, they give you a bonus. In other words, if I had $100,000, like we'd mentioned, and I drop into this, most companies are going to give me anywhere from a 5 to a 12% bonus just for the deposit. That means on day one, I pick up anywhere from $5,000 to $12,000 in my account. You know what we call that? We call that a good day. That's a terrific day. That's a day that you haven't seen in quite a while now in the years of 2000. That is a rare occasion. They will do that. So that's how those work. Some of them will give you a one-time bonus. Other companies will give you a bonus for 1 year. So as often as you put a deposit in, every deposit that year will receive a bonus. Some companies, we have two still, that will give you a bonus every time you make a deposit in the first 7 years. That's right. Every time in 7 years that I make a deposit, that money gets a bonus. And one company left that still gives a bonus anytime you put money into it. Now that is a very productive and positive thing. So that becomes huge. Well, what does that bonus represent? Well, whenever we do a bonus, the negative that you want to look at there is it does require you to be in the contract longer. Is that really a negative though? Well, if I take a bonus, that means I'm going to have to be in the contract anywhere from 10 or more years. The longest that I know of is about 16. But let me ask you this question. In your 401k, your Simple, your SEP, your IRA, your 403b, any government plan, how long is that contract? That's right. It's forever. Talk about a long contract. This one just means that you guarantee that you're going to keep the money in for 10 or more years, and that varies from company to company. So in comparison with what you're doing in your government plans, this is quite short. Number two, many of them will say again, well, they get a low rate of return. Did you know that on indexed annuities, the majority of these companies out there actually give you a guaranteed return? That's right. You can earn anywhere from a 5 to an 8% guaranteed annual return. Now, when we get up into the 7 and 8 percentile brackets, some of these are limited to 18 to 20 years. Gosh, that's horrible, isn't it? 18 to 20 years that you can earn a 7 to an 8% return as a guarantee. That's phenomenal. That means at the 8% level, every 9 years, your money doubles, just based on the guarantee. So that's a phenomenal thing to do. When you get to the lower ones, like the 5 and 6%, many of those go on for eternity. They just continue until you decide to pull the money out. So that is a huge, again, benefit that these particular products have. Well, what's the negative to that? The negative is, well, if you do sign for those, that means you've got to have now a lifetime contract on that fund. Well, is that, again, really a negative? Folks, if this is a retirement plan, if you plan on down the road using this money as a monthly, quarterly, semi-annual, or annual income, isn't the plan already going to be lifetime? Here's the key feature that these particular products offer. Not only do they give you a guaranteed rate of return, but they also guarantee that you will never run out of money. It is a guaranteed lifetime income. You can create an income stream here that you can never outlive. And many of them, I talked about that 8%. We have two companies that if you're doing what they call required minimum distributions, in other words, you're starting on the government plan and it's the basics, 3.7%, and it graduates up as the years go on. Did you realize that on these 8% plans that you can now pull out 3.7% on the RMDs, and that fund gets an 8% return at the end of the year? Do you see how you're preserving your income, your account, and that you can now pass on a legacy? That's the benefit that these particular programs have. So that is totally a myth on the fact that they don't earn. 3, well, remember, these funds are not very liquid. I can't get to my money. Folks, these programs, again, depending on the company, we have a couple of companies that you can get to 5% of your money first year. If you need to, if something happens, you can pull up to 5% out, no penalties, no fees, no charges. Can you do that with your 401k or 403b? No. As soon as you do that, you're taxed on that money, and if you're under 59.5, there's an additional penalty from both the feds and the state on top of that. They take approximately 50% or more in penalties and taxes. Here you get a 5%, and then after 1 year, a 10% penalty-free withdrawal. I can take up to 10% out, no fees, no penalties, no charges. That's a lot more liquidity than what you're used to in your current program. Much, much better. Plus the fund still continues to earn and it is protected. They also tell you that, remember, the risk is in the market. Well, again, a benefit of an indexed annuity is we remove market risks. If the market goes down, you still get those minimum guarantees that we talked about of 5 to 8% per year. That's as bad as it gets. Isn't it nice to know? I mean, we use the 8%. Wouldn't it be nice to know that you know in advance, in the next 18 to 20 years, you're going to earn 8% of that money? That's as bad as it gets. And in some cases, if the market does better, you get that instead of the 7 to 8%. That's the power that these have. Continual earning, continual growth, no market risk. That becomes a huge, huge benefit. Well, what about these fees they talk about? Well, they do charge fees. The average company charges somewhere between 0.6 and 0.95% per year. Per year. Now compare that to broker fees. The average broker, if you're lucky, charges 1.5%. But if you look closely, the majority of them charge that per quarter, not per year. And the ones who charge it per year also charge administrative fees and broker fees on top of the 1.5%. On average, you lose anywhere from 4% or greater in those arenas. That's not the case here with the indexed annuities. The fees are much more reasonable. And they're once a year. They're not every month. They're not every transaction, they're not for administrative costs, and they're not for any other fees. They state it in the contract and you know it up front. What a different value that is to you and your retirement, to know these things up front because it's all in writing. The other benefits that these have that the other accounts don't is what happens if I'm in trouble and I have to go to the hospital and I end up in long-term care, or I have a terminal illness. Well, these annuities all have within their contracts built-in features that if I do have long-term care, I can actually use now my annuity product as a payment towards that. In fact, they increase, depending again on the company, that annual withdrawal, if it's during the surrender period, from 10% to 20%, in some cases up to 50%, that you can pull out in order to facilitate making payments on long-term care. And if it's a terminal illness and you've been diagnosed that you got 12 months or less, you can take up to 100% of those funds out to take care of the necessary things you have to. All surrender fees, all costs, anything associated with that is waived. You don't have to pay anything. Now here's the other thing that I think is a key feature. Think about this in your future. The federal government has done a study and they asked the baby boomers who are just now beginning to retire how they are looking to supplement their incomes, because many of them don't have the financial wherewithal to make it through retirement. They've got to supplement their income. 1 out of every 4 people said that they intend, you'll like this, supplementing their income through lawsuits. Isn't that sad? It is, but that's what they're planning. And it's there in the documents for the government. Well, let's look at that. Let's say someone decides to sue you for some civil, criminal, or liable reason. The first question I ask is the equity, if you have any left in your home, is that safe from lawsuit? No, it's not, is it? How about your Social Security? Is any part of that Social Security safe, or can they come after that? They can come after a percentage of it, but not all of it. So there is some safety within your Social Security. The problem is the government's already rated it. So there's not much there, if any, on your Social Security. Well, what about your 401k, 403b, Simple, SEP, IRA, Roth? Did you realize that in a lawsuit, there is no protection whatsoever from that retirement instrument? They can literally take it all. That's the truth. Isn't that sad? Well, what about an indexed annuity? Do you know, because it is a prearranged settlement, it falls under the umbrella of a life insurance contract, it cannot be touched as a result of lawsuits. At all. You've just created not only a wonderful instrument that is good for retirement, that creates an income that you can't outlive, that's guaranteed to earn money each and every year before you retire, and it won't go down. It's protected from the market, but not only that, you have just protected it from frivolous or other lawsuits. We have a great example of that. You may not like the person, but he's a wonderful example. If you remember when O.J. Simpson was released from his trial and was not found guilty, that the Goldmans and the Browns went after him civilly. They sued him in court and they won. Now this is a guy that has a lot of money. How much money did they get from him? None. Why? Because his money is tied up in 2, or actually 3 specific instruments. 1, pensions, which are still protected. 2, annuities. And 3, life insurance. They're protected instruments, and even in a lawsuit you can't touch them because they are a prearranged settlement, and it's against the law to touch a settlement. So folks, those are the pros and cons of an annuity. That's how they work. Those are the nomenclatures. Each one differs from company to company, but that is the basis of it. It is a fund that is guaranteed, insured, protected, and it protects your retirement with guaranteed growth. Thank you. I'm Tom Barnett, and I'm glad you listened.